Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this segment, we have Steve Wyett, Chief Investment Strategist at BOK Financial, and Steve Sosnick, Chief Strategist at Interactive Brokers. We're here to discuss the increasing bifurcated economy and markets. It's great to see both Steve, as always, and Steve W. We'll kick it off with you. This really seems to be the tale of the tape. The narrative that we're hearing more about is the bifurcation that we're seeing in the economy, how consumers are perceiving it, and of course, how that translates into the markets.
Yeah, I think that's right, Jill. I think at the base of that is that the impact of what the Fed has done is having a differing impact as we think across the income spectrum. But what's interesting to me as well, and I'm going to be interested to get Steve's take on this too, is that we're seeing that in the capital markets as well. If we just think about the difference between what's going on in large cap and small cap, but when you think about consumers, the lower half of the income bracket, those higher rates are having a real impact. The increased cost of credit card borrowing, car loans, that type of when that's your access to liquidity, it's very expensive. And so I think this is where the Fed is going to have to be considerate of how their policy, what it feels like going forward. Because the longer they keep these interest rates at these levels, the more of an impact it's going to have on on the lower half of the income bracket. And you just look at some of the data, you can clearly see what that's doing. Now, economically, Jill, this is where it kind of gets interesting because from an overall economic standpoint, from economic activity, the lower half of the income brackets are not nearly as impactful as the upper half. And so it could be that the economy still appears to be moving along pretty well. But politically, if we're going to talk about the political impacts of this, everybody's vote counts the same. So it's this differing impact of where this is of what this is having, and the disparity is growing as we move forward.
Yeah, and this is something that we've spoken about with both of you on previous shows. And Steve S., there was a survey that was brought that CNBC had reported on, right, where 401ks in your retirement, in your asset, if you do have those types of accounts, they're sitting at nearly all-time highs, depending on how you're invested. Whereas a lot of the respondents to these types of surveys have said they feel like unemployment's the highest that it's ever been, or we are in a recession. But when you look at the data, that's clearly not the point. But as the everyday consumer, and I feel this way, things are definitely more expensive when it comes to insurance, housing costs, and even when you go to the supermarket, the amount that we've seen inflation increase, right, 20 to 25% more, that we feel, and we can all understand that. And I think that's really going to supersede some of the data, particularly in an election year.
Yeah, Joe. Well, there's a couple things to break apart here. Number one, to Steve's point about sort of the bifurcated economy, high rates benefit savers, low rates benefit borrowers. And for better or worse, the people at the high end of the income table have money to save and invest. And the people who are at the lower end don't have that luxury and really have to watch live paycheck to paycheck. And so as a result, they're not getting the benefit from having the savings. Again, being invested in the markets right now has been terrific, but realistically, if you just leave it in the bank at 5%, you're doing fine. So, this is very much in favor of one, sort of the higher end of the income distribution than the lower end of the income distribution. The second part is, Paul Krugman in the New York Times wrote about it, and I know not everybody agrees with his politics, but I do trust him as an economist. He's got the Nobel Prize to prove it. And it was about why people perceive why there's sort of inflation truthers out there now, why people perceive that the government's lying to them about inflation. And the problem is it's a subtle difference, because inflation is, when you hear about disinflation, that tells you that prices are going up more slowly. It's the second derivative of prices. Inflation is the first derivative of prices. And disinflation is the second derivative. It's the pace at which inflation is growing or shrinking. But that doesn't mean prices are coming down. So as you alluded to, prices are 25% higher almost across the board. But if you hear that there's disinflation out there and everybody's trumpeting that inflation is lower, it still means prices are going up. And if you're a bit stretched, they're not coming down. Forget if you're stretched or not, they're not coming down, but it hurts more the more stretched you are.
Well, and Steve Wyett, the question is, even if the Fed were to cut 1, 2, 3, in my mind, I highly doubt that. Is that really going to move the needle in terms of how expensive things feel? And then if you do get multiple interest rate cuts, isn't that a signal that perhaps there's some stress in the overall economy? It feels as if, their hands are tied if you're thinking about it, those kinds of semantics.
Yeah, that's right. That's right, Jill. I mean, 25, 50, even 75 basis points. If you think about it, that's going to be enough to really come to the rescue of those that are hurting from the higher interest rates. Probably not. It does look, it's the direction that they're moving that impacts what's happening from a big perspective. But let's be clear, Jill, the Fed's kind of between a rock and a hard place in this, because while we're getting some data that the economy may be slowing, GDP was revised down for the first quarter. We can see some retail sales numbers that are showing a little bit slower growth. But you just look at when the employment market, maybe from a mosaic standpoint, appears to be coming into better balance. But then you throw that average hourly earnings number that came in with the DOL at up 0.4, hotter than expected. And that's a key aspect of what the Fed's trying to do. You just look at those sticky areas of inflation, be that rents, be that wages, to your point, auto insurance or homeowners insurance. That really kind of puts the Fed on their heels a little bit about being able to be aggressive enough to help, as you say, without risking maybe spurring a level of demand that kind of reignites some of that inflationary pressure going back higher. So this is a really interesting kind of a mix for the Federal Reserve. We think the Fed wants to begin to lower interest rates, and we say that because ultimately that's going to be a signal of victory for the Fed. They tightened enough to slow things down. Now they can begin to lower interest rates. That should be additive and helpful. That can change their messaging a little bit as it pertains to maybe how people feel about what's going to happen in the future. But for them to really be able to do enough to help from that. I mean, what's the difference between 25% on your credit card and 24 3/4? That's probably not enough to make a big shift in what's happening to your monthly budget if that's where you're having to go to make ends meet. So it's important, we think, from a directional standpoint, Jill, but the actual impact of that is going to be a little bit more limited.
Right. And Steve Sosnick, let's talk about some of the trading news of the week. Of course, NVIDIA with the 10-for-1 stock split, that has investors excited, but we also have to remember too that, it might be from a capital perspective, more affordable to get into a share of NVIDIA, but it doesn't necessarily change the valuation of the stock.
No, I mean, it's exactly what we did is the market made change. You had a $10 bill and now you have 10 $1 bills. Some people like having fewer bills in their wallet. Some people like having more bills in their wallet. It does make it this used to make a huge difference when stocks traded in round lots, which meant that there was a penalty if you didn't trade 100 shares at a time. Now, nothing really trades in round lots. Even the biggest orders get sliced and diced so that they trade it in very small increments. And the shares have been accessible because of fractional share trading for some time. So it doesn't really do much in terms of making the stock actually more accessible to investors. The one set of traders that it does make it a bit more accessible to is actually option traders, because you've cut the strike by 10, and the contract size effectively got raised a bit. So it can be a bit cheaper to enter into an options contract. But I'll tell you, from the volume we've seen on our platform, that hasn't been an impediment so far, because it's been the most active option on our platform by a wide margin. Even during the meme stock craze, it was still outpacing GameStop. So people know to trade it. Honestly, I thought this would be a bit more of a sell the news event. So far today, it hasn't. The fact that they got 3 price target upgrades certainly has helped. But the market, I made the comment last week that it's NVIDIA's market and we're all just trading in it right now. And I do think that is the case. And that's why I as much as I think this stock is an earnings machine and a juggernaut right now, it brings a very high level of risk to the market, because if this stock stumbles, the ramifications will be wide.
Right. And Steve, speaking of the meme craze, I mean, GME, this seems even more crazy. I can't even think of a better word than the first time around.
This one I described very clearly. As the first one was sort of it was kind of an organic us versus them thing. People were disaffected. They were, they were stuck on social media, not really interacting in person. And you had a lot of new investors in the market because of, zero interest rates and stimulus checks. And, so on social media, this became a narrative. It was very much about nostalgia that millennials would feel for certain companies. And specifically in the case of GameStop, it was, how dare these evil short sellers? By the way, I think short selling is a neutral activity. It's sell high, buy low. There's no morals to it, or lack thereof. It's neither here nor there. But how the narrative became, how dare these evil short sellers bet against it? Roaring Kitty put out a fundamental thesis, which I don't agree with, but part of that was that there was a short squeeze, which did make sense, and off it went. And it was very much there was an enemy there. Now there is no enemy. And and the comment I raised was, if it was us versus them at that point, and you don't know who them is, well, them is probably you. And, so that was very much a situation where I think they were really just trying to exploit the faithful. And then on Friday, in a Bloomberg story, I used the comment that it'll be like a Scooby-Doo mystery where they take the mask off to see if Roaring Kitty is still himself. And in this case, it was as though Scooby-Doo himself was in charge of the crime, was the mastermind, because that was one of the most bizarre things I've ever seen. And that's why the stock plunged, because it had gotten so far ahead of itself. And then you realize the mastermind is, I don't know how to describe him, but it was just, let's say it didn't inspire a lot of awe in me as an investor.
Yeah, it was hard to follow at best. But Steve Wyett, I'm curious to get your thoughts around this. I mean, it makes you wonder if perhaps the professional trading community needs to kind of think about how these meme stocks can potentially impact a position. It's just another variable in the market that I think they have to have in the back of their minds.
Well, a couple of things. I do want to mention one group, Steve, that is fine with the NVIDIA 10-for-1 stock split, and that is the cents per share brokers out there, that they are now generating significant. So for money managers that do soft dollar business, having more shares to trade is better for that than having fewer shares to trade. That's a small community out there, probably no reason for that to necessarily play into the decision-making process, but that's one group that is happy to see NVIDIA split 10-for-1. So, Jill, I think more broadly, when I see stuff like what's happening with GameStop, if you look at even Bitcoin, some of the crypto coins, this to us is just it's a measure of liquidity in the market. And so if there's a thought that the Fed has been overly restrictive and there's a lack of liquidity in the market, when you see stuff like this happen, we just go, nope, there's still plenty of liquidity out there. There's still plenty of risk-taking money that is willing to take something that, if you just start to break that down from a fundamental standpoint, as Steve said, there's no story here. So why is this happening? Now, you can build a case that in effect, a stock is just a commodity. And if you get too much on one side or the other, when you can't mess with the supply, or when longs can require delivery of that share, that's where that short squeeze can come in and really in a short term play havoc with pricing in the market. But the financial aspect of what they did, heck, the company took advantage of it. They issued what, Steve, another 920 something million in equity that they were able to do on a market share basis. So, they took advantage of what was going on out there. I just look at who's doing this and where the players are, and it's just fraught with types of risks that you'd have to say that the majority of investors do not fully understand. And our big deal is, look, it's fine if you lose money when you know what the rules of the game are. But when you lose money in a way you didn't know you could lose money, that becomes very disconcerting in a hurry. And I don't think that's additive to the market overall.
Just to amplify that point, Steve, the problem is, I think a lot of the investors who are most caught up in this are the ones who understand the risks the least in some regards. They're either willfully blind to it, because believe me, I've gotten flamed on social media when I dare to question the thesis behind some of this, or or they're just sort of sucked in by momentum and and just trade, basically trading it because it's going up. So that that to me is another element of this that I find unappealing, because it does sort of, and that's kind of why I focused on the us versus them aspect, because who's going to be the source of liquidity? Who is this guy going to exit to? And your point about the GameStop selling $933 million, I think it was $933 million worth of stock, that actually is about their negative cash flow for the prior 3 years, give or take. But now they announced they'll sell up to another 75 million. Keep in mind, companies don't sell stock in their own company if they think it's undervalued. Let's put it that way.
And what's so interesting about this, and we'll wrap on this note here, and this could be a bit cynical of me, but this isn't the first GameStop AMC scenario that we will see, and it certainly won't be the last, and it won't be the last time that we've seen situations like a Madoff or other nefarious uses of the market. It's human psychology to, short-term memory to try and get that lotto ticket. It's just part of human psychology, which is why I was asking the question, should traders continue to be prepared for these types of events? But that'll be a conversation for the next time that it happens. Steve, thank you so much as always for your insight, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.